Hi everyone, welcome back. So today we'll be starting with portfolio theory. Just to recap, what we have covered till now is we have learned about financial instruments. We have learned about TVM and we have learned about the risk and return characteristics, right? And how do we calculate these values? So now portfolio we'll be starting with portfolio theory. So that is the next part in this whole course. So let's get started. We'll be first seeing the learning outcomes. So we'll understand the key principles of portfolio management. We'll measure and compare portfolio risk and return. We'll understand the portfolio theory. We'll apply these concepts in Python to optimize investment portfolio. That we'll be doing after we are done with this module. Okay, so let's get started. First of all, the biggest question is, what is a portfolio? Okay, so in my terms, portfolio is a combination of assets, financial assets, instruments or assets, whatever you can say, uh, kept together. So basically we can see here it is a collection of financial assets like stock, bonds, commodities, real estate and cash equivalents. We did cover all these, right, when we were studying in the first module. So it can also include funds like mutual funds or like ETFs. So basically, let's say you have a portfolio, okay, and that portfolio, can have, let's say, stocks, it can have bonds, real estate. The distribution you can decide, how much these assets contribute to your portfolio. That's up to you. But what we can also have is, we can have, let's say, stock and bonds, okay, plus some mutual funds or ETFs. So it can be a mix of both of them, right? So you can manage some of these on your own, right? Stocks and bonds you're buying on your own, and you can purchase some ETFs or mutual funds that is managed by some other person. Got the point? Okay, so now let's come to the purpose. The primary purpose of portfolio is diversification. So let me cover this. So as I told, right, stocks are risky, right? Stocks are risky, but whereas if you buy government bonds, right, they are safe, they are backed by government. And so if you add bonds to your existing portfolio of stocks, right, the overall risk of your portfolio reduces. Got the point? So see, diversification reduces risk by spreading investments across various asset classes, sectors and geographical regions. So yeah, you can also do this. What you can do is, let's say you are an investor in US. You can buy stocks in US, but then you can also buy stocks in India. So you are diversified. So let's say if something wrong goes wrong in in US, like for some company or for some this, let's say there's a change in tax regime or something. So but you will be saved because you have certain allocation of your portfolio to Indian stocks. Okay, so by holding a mix of assets, the negative performance of some investments can be balanced by the positive performance of other, leading to a more stable overall return. So let me build an example. This is just an hypothetical example. Let's say it's a span of 3 years. And you had a portfolio of stocks and bonds. So stocks, in these 3 years gave you returns of minus 10%. In short, like if you had 10,000, right, if you had invested $10,000, they would have become after 3 years they would have become $9,000. Got it? But if, since you had bonds in your portfolio, right, you would have received every year the coupon payments, and the principal and the face value at the expiry of the bond, right, at the maturity of the bond. So see, that's what we discussed here, right? The positive performance of others can balance the negative performance of some investments. Got the point? So I think that's what we have explained here. An investor might diversify their portfolio by holding 40% in stocks, 40% in bonds, 20% in commodities. This mix allows the investor to benefit from the growth potential of stocks, the income stability of bonds, and the hedge against inflation that commodities provide. Got it? So if you don't understand this line, right, let me explain this as well. The hedge against inflation that commodities can provide. Basically, see, what they try to say here is that, if inflation is there, right, commodities will protect you against that, because the price of commodities will also rise accordingly. Got the point? So let me clear the screen and let's move ahead. Okay. Now coming to portfolio return and risk. Okay. So we have covered return and risk, but let's see this in the terms of a portfolio. Okay. So portfolio return is the expected value of combined gains and losses from all assets in a portfolio over a specific period. It is usually expressed as percentage of initial investment. So let's understand this. Okay. So let's say you had stocks. Okay. Let's say they have 50% of your portfolio. And let's say you had bonds. They were 50%. So let's say bond gave you 10% returns over a year, and let's say equities gave you 15% a year. Okay, this same year. So what would be your returns? 15 into 50%, 10 into 50% divided by 2. Got the point? So that becomes 7.5% plus 2.5%. Oh, sorry, 5%. Got it? So that becomes 12.5%. So that is return. Okay. Portfolio risk, it refers to the uncertainty about the portfolio's actual returns. It is often measured by variance and standard deviation of the portfolio's returns. So we did cover variance and standard deviation, right? And I think the third module, right? So it's the same thing. We'll learn to how to calculate portfolio risk, basically variance. It's based on a formula. We'll be covering this when we will be implementing this in Python. Okay. So again, it's the same thing, right? When this variance indicates how much the returns of the portfolio differ from the mean return, while standard deviation measures the dispersion of returns around the mean. Basically, it's about the dispersion from the mean. Got it? So yeah, that's about risk and return. So a few pointers, right? Because we'll be discussing this in the next slides. So I wanted to discuss this right now. First of all, risk-free rate. Okay. So it is. Let's first see the definition. Okay, and then I'll explain you. So it is the return on an investment that is considered completely free of risk. Okay, it represents the minimum return an investor expects on any investment because it compensates them for placing the money in a risk-free asset over a specific period. So basically, let's say we can understand that risk-free rate, okay, is the return that you earn for investing in an asset that is completely risk-free. Okay, let's say government T-bills, okay, treasury bills. So they're backed by the government, right? So they're completely risk-free. They won't default. Okay, you are sure that they will give you your money back. Okay, along with the coupon payments. So if that is 2.5%, right? Let's say the T-bill coupon or interest rate, it's 2.5%. Then if you have to invest in any other asset, right? Let's say corporate bonds or equity, you would at least require this much of the return. Okay, because this you will anyways get if you invest in risk-free assets, correct? So that's what we have explained here. It is the minimum return that an investor expects from any investment because it compensates them for placing their money in a risk-free asset over a specific period. Got the point? So I hope I'm clear. Then Sharpe ratio, okay, it is a measure used to evaluate the risk-adjusted returns. Okay, this is the main word, risk-adjusted return of an investment or portfolio. It indicates how much excess return an investor is receiving for extra volatility endured by holding a riskier asset compared to a risk-free asset. Don't worry about this whole word. Okay, what we are trying to convey here is that first of all, higher the Sharpe ratio, that is the better it is. Okay, so basically whatever the risk you're taking, right? Standard deviation is the risk. So if you're taking more risk, you should be giving more return. It should be higher. So that's what I'm trying to say. Basically, Sharpe ratio tells us, okay, what is the risk adjusted return of your investment. Okay, so let's say if you have two portfolios, A and B. Okay, both of them have a risk of 15%. Okay, and let's say the risk free rate is RFR is 2.5%, and the returns that portfolio A gave was 10%, and the returns that portfolio B gave was 15%, or let's say 13%. Okay, so now if you calculate, right, for portfolio A the Sharpe ratio will be 10 minus 2.5 upon 15. Okay, that will be 7.5 upon 15. That becomes 0.5. If you do it for portfolio B, that will be 13 minus 2.5 upon 15. That will be 10.5 upon 15. So that will anyways come out to be 0.68 or 69 something. So that is definitely higher than 0.5. And we can see that if you had gone with portfolio B for the same amount of risk, you would have earned more returns. So it has a higher Sharpe ratio, and the higher the Sharpe ratio, the better is your investment. So got the point? So that's all what we have for this video. Okay, if you like this video, please hit the like button and subscribe to the channel. Also, this whole series of lectures, right, on portfolio theory is part of a broader course that I've created on quantitative finance. So if you want to learn about quantitative finance in a structured way, please you can enroll in that course. I've provided a link in the description below. Thank you.